High-frequency trading. It's the world of cyber business where stocks are bought and sold at warp speed. It's come to dominate the US markets where traders use sophisticated, super-fast computer programs. While it has a smaller role here, it's still dividing opinion on whether it's taking the traditional stock exchange and what regulators should do about it. Rebecca Nash reports.
Clearly, the computer age has transformed the world's stock exchanges, but in the past decade it's gone to a new level with the advent of high-frequency trading, or HFT, no more so than in the United States, where it's believed to be more than 60% of trade.
The average holding period of a stock through this process has become 11 seconds.
The high-frequency trading is there to create a lot of liquidity, and it does create some good volume for people in the marketplace.
Trading is now at such speeds, a recent study found markets are rising and falling in nanoseconds, much faster than can normally be recorded. But apart from the obvious impact on volatility and spreads, there's still quite divided debate about where HFT is taking the markets.
The real concern here is that may distort the underlying purpose of the actual market itself and also bring about enormous destructive volatility.
I think a lot of people have picked up high-frequency trading thinking that thinking about the flash crash, and that's tended to demonise it a lot.
Such division doesn't surprise Professor Michael Aitken. He says the measures in place to identify any effect HFT may have on prohibited trading are lacking.
We don't even require brokers to tell us when they're trading as principal or agent in order to be able to work out whether someone is front-running or not.
And then there is the question of whether this kind of warp-speed trading undermines the original purpose of a stock exchange. It's even made its way onto prime-time satire.
We've all heard that the way to make money in the stock market is to invest in a company you believe in and hold on to that stock. Well, there's a name on Wall Street for people who do that. Suckers!
It's a concern the head of the ASX has acknowledged.
We have to make sure that those kinds of activities don't ultimately interfere with what the market is for, which is capital formation and bringing back together people who have money with people who need money.
They can't tell whether the price movements are driven by real buying or selling or just these computerized trading algorithms.
But David Horsfield dismisses such concerns.
They should benefit from it because what actually happens with increased liquidity, it means that the spreads get closer, so they should be getting better prices.
ASIC says it already has rules in place that mitigate some of the concerns about HFT and is discussing further regulation with the industry.
To assume that A, regulators have the sophistication, B, the tools, C, the expertise to deal with that, I think is drawing a long bow, as they say.
There are concerns ASIC is too reliant on self-regulation and compliance. Professor Aitken believes that Australia is blindly following the US regulators' lead on this.
One of the strategies is to close down the market in some situations. I mean, what evidence did the SEC provide to suggest that closing down the marketplace was good for the marketplace?
One has to be careful that we don't have gold-plated regulation to cause increased costs, which will cause us to be uncompetitive in global markets.
Perhaps an indication of the widely varying responses to ASIC's proposed risk management controls that the regulator is currently sifting through.